Most people treat this account as a short-term tool for covering standard doctor visits and pharmacy copays. That tool is the Health Savings Account, or HSA. Access to it requires enrollment in a high-deductible health plan, a specific insurance requiring higher out-of-pocket costs before coverage begins. This chart details the 2024 limits. Your health plan deductible must be at least $1,600 for individuals or $3,200 for families. If met, you can contribute up to $4,150 individually or $8,300 for a family. If your health plan meets these criteria, you are eligible to access a specific set of tax advantages that are unavailable in any other type of account. To see why these advantages are unique, we have to compare the HSA directly against the retirement accounts you already know. A traditional 401k gives pre-tax contributions, but taxes your withdrawals. A Roth IRA taxes up front, offering tax-free growth and withdrawals. The HSA gives you all three: pre-tax contributions, tax-free growth, and tax-free withdrawals for medical expenses. The HSA is the only account in the tax code that applies three distinct tax advantages to the same dollar. To qualify for that final tax-free withdrawal, the money must technically be used for medical expenses. But you do not have to use the funds to pay for medical expenses at the time they occur. You can use the shoebox strategy to turn this spending account into a long-term investment. Instead of using your HSA for a current bill, you pay out of pocket. You then save every medical receipt, doctor bill, and explanation of benefits you receive. By paying for routine costs with outside cash, the money inside your HSA stays in the market, where it can compound in index funds over several decades. This timeline shows the math. If you have a $200 medical expense in 2024, you pay out of pocket and keep the receipt, while leaving your $200 HSA contribution invested. Over 20 years, at a 7% average annual return, that $200 grows to $772. Because the IRS has no time limit on self-reimbursement, you can submit that 20-year-old receipt in 2044 to withdraw your original $200 completely tax-free. The remaining $572 of profit stays in the account, where it continues to grow without being taxed. Maxing out an individual HSA for 30 years at a 7% return results in a balance of approximately $414,000. This strategy converts every medical receipt into a voucher for a future tax-free withdrawal. You may reach retirement and find that you do not have enough medical receipts to claim the entire balance of the account. This chart displays the penalty for non-medical use. If you withdraw HSA funds for anything other than healthcare before age 65, you owe ordinary income tax plus a 20% penalty. However, once you turn 65, the 20% penalty is removed. After age 65, you can withdraw funds for any reason. You simply pay ordinary income tax on the withdrawal, making the HSA function like a second traditional IRA for non-medical expenses. Since Fidelity estimates the average couple needs $315,000 for healthcare and retirement, most people will likely still use the account for its primary tax-free medical purpose. This structure allows the account to cover healthcare costs without triggering taxes, while providing an additional source of retirement income for any other expense after age 65. To use this strategy, you must fit it into your specific financial priority sequence. This flowchart shows the recommended order. Maximize your Roth IRA first, maximize the HSA second, and then focus on your 401k. Many employer-sponsored HSAs have high fees and limited investment options. Independent brokerages like Fidelity offer HSAs with no account fees and access to zero-fee index funds. You can keep an employer HSA open to receive their contributions, then transfer those funds into an independent HSA once a year to access better investments. Verify your health plan's deductible, open an investment-focused account, maximize your contributions, and save your receipts. While you should consult a tax professional for your specific situation, using the HSA in this manner allows compound growth to secure your future costs.